Welcome back. Now, geopolitical risk is weighing on the oil market. Protests in Iran are fueling supply disruption concerns. Added to this, the U.S. now has de facto control of Venezuela and has a naval blockade in place preventing oil exports from the OPEC nations. And while these factors weigh on the oil industry, the expectation is that the market will be oversupplied this year. David Elmes from the Warwick Business School joins us with his analysis of what's playing out in the oil market. David, hi, good to chat to you. Thanks for joining us on Business Lunch. US President Donald Trump has declared himself the acting president of Venezuela. Talking about oil now, he's making sure it goes to the United States. Is this realistic? We heard about 50 million barrels going to the United States. What do you see happening?
Well, Venezuela currently produces about 1 million barrels a day. And so the idea that sort of 30 or 50 million barrels could now go to the US. I mean, some of that production historically has gone to the US, but quite a lot of it's gone to China. About sort of 80% of it's gone to China. So it would divert oil that historically has gone to China into US markets. But people in the US, oil and gas companies, are very mixed as to whether this is a good thing. For some of the big companies, such as Chevron, who already has a position in Venezuela, they say, oh yes, we would invest in Venezuela if you guaranteed the situation. Some of the other big companies like Exxon have said, no, Venezuela remains uninvestable. But the people who are really annoyed are the smaller producers from the US sort of shale oil and gas, because what they see is this is Trump investing in production in another country that's then going to compete with their production and generally keep prices down. And at the moment, the price around sort of $60 a barrel, it's just been below that. That's sort of the minimum price those guys need to be able to sustain production. So they're not very happy.
It's interesting you say that. If I was an oil executive, would I want to go and invest in Venezuela? And like you say, a lot of them say it's uninvestable. But even if you go to Venezuela and you invest tomorrow, what happens in a few years when Trump's not there? It's not a long game.
Well, that's why Darren Woods, CEO of Exxon, is saying, well, it's uninvestable really, because he's saying, Exxon as a company over history has had their assets in Venezuela sort of taken away from them twice. And yes, oil and gas is a long-term business. What you invest today, you're looking to pay off for 10, 20, 30 years over the future. And that's an awful long time in either American politics or Venezuelan politics.
Mm. You spoke about OPEC as well. I mean, OPEC, these have been the oil guys that we rely on. They have their meetings, they then decide on production and outputs, and that determines fuel prices. What do you think they're thinking at the moment? Because this doesn't include them.
No, I mean, both sort of Venezuela and also Iran are obviously OPEC members, but they're under sanctions. At the moment, the estimate is there's probably around sort of 3, possibly 4 million barrels a day of production capacity that's just not being used. And this is not being used because the OPEC members want to keep production under control so that they can keep the price up. So part of the reason why there hasn't been sort of massive concerns in the commodity markets with what's happening in Venezuela is there is this knowledge that, well, there's probably more than the capacity of the whole Venezuelan production that could be brought on board fairly quickly if things happened and things went south in terms of production coming out of Venezuela. So OPEC is sitting there saying, well, to be honest, not quite sure it's a great idea to invest in more production in Venezuela, and we've got a surplus production capacity available now if the production capacity of Venezuela goes down. So that's why there hasn't been sort of massive concerns in the commodity markets.
Yeah, but you did speak about Iran and what's happening there at the moment now. They've got mass protests. I think the death toll's gone north of 500 so far. If we see a situation with Iran of total instability, and that could happen, what happens to the oil price?
Well, I mean, the first thing to say, what's happening in Iran is tragic. I mean, the loss of life is really, really sad to see. I mean, Iran sort of, produces or exports about sort of 1.5 to 2 million barrels a day. So, twice as much as Venezuela. And the other thing to note is an awful lot of that also goes to China. There's a bit of a theme here. These are countries who currently export quite a lot of oil to China, both of them. Chinese are happy to buy this oil because it's often at a discount. The oil from both Venezuela and from Iran, is sold at a lower price because it's coming out from under sanctions and so on. And there's all sorts of murky stuff about ships sort of moving it around and so on. When you look at the sort of exports from Iran to China, it's about 14% of China's imports. And so you start seeing, well, okay, Venezuela, if that sort of stopped, production capacity could probably mop up that. But then if you add in Iran as well, you say, okay, that's sort of heading up towards the production ceiling. And the other one is that there's issues about regional instability in Iran in terms of, the gas that's exported from Iran to Iraq is what powers their electricity, and so on. So you start to see a slightly more sort of unstable situation. But I suppose the interesting question for me is both of these nations, the current biggest customer for their oil is China.
Sure. So there it is. China is not the United States. David, thank you so much. Good to have you with us on Business Lunch. I do appreciate you taking the time. Thank you. That was David Elmes from the Warwick Business School.